Okay, so same booklet that I gave out yesterday on Friday. This is the booklet that includes everything that you need to know for your test. This is a B1 V2 test. It is worth 20%. It covers transaction analysis, which is this A3 sheet, ledgers and trial balances, as well as a small portion of theory questions. Okay, recording principles is where theory questions are. It'll be worth about 10 marks, okay, in your test. Alright, so the test order, okay, will look exactly the same as this booklet. I gave you 2 sets. This is for the sake of practices, okay. So this is the first set. First set is snow plane. So in the test, you'll get given cover page, which is rounding rule and how each section is divided, and then the formula. Your formula in the test will look exactly the same as what I pasted here for you. And then first set, the business that you have to practice is snow plane, and then you have to record the transaction on the A3 sheet. Okay, so only 10 transactions. Okay, in the past, students used to do like 20, but we've made it easier now. Okay. And after you've completed the A3 sheet, you then have ledger accounts to enter, okay, here. And then after you've completed the ledger accounts, you then do the trial balance. Trial balance is there to prove that you've done everything exactly like correct, okay. After trial balance, you have theory questions. So these questions are very similar to your test questions as well. So, you know, give them a go. And I've already like done the first practice with you, and I've also done the practice questions with you as well in the class. And then the second test after Mr. Sherlock Holmes, it's just a different business, okay, where you read the transactions and then you record it on the A3 sheet. After you've completed the A3 sheet, you do the ledger accounts. After the ledger accounts, you do the trial balance, and then finish off with practice questions. The practice questions here are exactly the same as the ones in the first set, okay, but I just changed the business name, but the method and everything should be the same. Again, it's for the sake of practice, okay, like practice again and again, practice, you know, so you'll feel more comfortable with the test, okay. So for today, I will do the second set with you, which is Overcooked. So we also did this as part of our game as well. Beside me, I'll have chart of accounts. This is just to show to you how helpful this can be, but unfortunately you won't be given this in the exam, okay. You have to, like, you already expected to know already what an expense is, what an asset is, okay. We already did a whole test on, you know, defining assets, defining liabilities, defining expenses, okay. And I will also have the A3 sheet with me, and here just a piece of paper to show you some of the, I would say, error rules that I taught in the class, that I told you, okay, maybe use them as a guide, okay. All right, so the error rule that I told you in the class is debit and then credit, okay. So if we look at A3 sheet, asset, expense and drawings on the left side, these are the debit side, okay. Liabilities, capital revenue on the right side, they are the credit side, okay. So the rule is, if something increases on the left side, which is the debit side, if the transaction happens to be on the right as well, on the right side, which is the credit side, must also increase. That's the first rule. Second rule is, if something on the debit side decreases and another account happens to be on the credit side, it must also decrease as well. Third rule, if something increases on the debit side, something on the credit side, if another account happens to be on the debit side again, okay, that thing must go down. So if they're both on the same side, if one thing increases, the other account will decrease. Okay, so that's a guiding rule that can help you. I will put this here. Okay. And then transaction fold in half. And have this with me. Okay, again, if you are ever lost, feel free to pause the video, okay, and then email me any questions that you have. I'm here to help you. Okay, all right. So instruction is complete the transaction analysis sheet to record the transactions above, actually the transactions are below, and complete the column totals. So these are the column totals. BAM runs a cooking school in Dunedin called Overcooked. So the business name is Overcooked. The business sells a range of branded cooking merchandise as their inventory, as well as providing lessons. So what the business does or sells for a living is branded cooking merchandise, like cooking equipment, okay? And they also provide cooking lessons as well. So those are the two things that they do for a living. The following business transaction took place during the month of October 2023. First transaction, cash sales of $5,000 for lessons. Okay, so if you attended my foundational lesson where I taught you about cash transaction, I also told you about credit transaction, I also taught you about COGS plus inventory transaction. Okay, cash transaction, how do you know that it's cash? You have to read the transaction, and then if it says cash, that means the business bank account, the cash in the business bank account will be affected. Okay, so if it's cash, you have to think of bank. But if it's a credit transaction, for example, like second transaction, purchase inventory for $2,000 on credit from Southern Hospitality. After you read that, you have to think, oh, is this a cash transaction? But they bought it on credit, so it's a credit transaction. Okay, if it's a credit transaction, does the business bank account, has it been affected yet? Does the money in the business bank account move yet? So if you bought inventory on credit, your bank, okay, the money in the business bank account is not affected. You got the products, but you haven't like paid yet. Okay, so it's a credit transaction. So you have to think about ACREG, account receivable, and ACPay. Okay, if it's a credit transaction. For COGS and inventory transaction, you will always see COGS in a transaction that has two different numbers, and I would tell you, oh, the cost of the inventory was this much. So if you get given how much did you have to pay to get the inventory, COGS will come, okay, because basically you successfully sold your products. So and I also told you how much you acquired the inventory for. If you sold your inventory, you can't keep your inventory, and there's always an expense that will arise, which is COGS, cost of goods sold. Okay, so COGS inventory, look for a transaction with two different numbers, okay, in one transaction. Okay, so only 3 types of transaction, okay, that we're doing. All right, I'll put this here. Okay, all right, let's read our first transaction together. Cash sales of $5,000 for lessons. Okay, it already states in the question that it's cash, so it's a cash transaction. the business bank account is affected. Okay, so transaction 1. Okay, and if we know that the business bank account is affected, okay, the cash in the business bank account is affected, we have to know already what is the accounting element of cash. When I talk about accounting element, I mean, is the cash in the business bank account an asset, an expense, a drawings, or liabilities, a capital, or revenue? Okay, in this case, the cash in the business bank account is an asset. Okay, yeah, if you look at your chart of account, see bank account. Okay, it's an asset, and when you made a cash sales, what happens to the money in the business bank account? Will it go up or down? It will go up, right? So account name here will be bank. Bank is the same as cash at bank, but we call it bank because imagine if you have to write cash at bank every time, you know, it's too long. It's gonna be quite tiring. Okay, again, bank is short for cash in a business bank account or cash at bank. If we made a cash sales of $5,000, we gain that money, so our asset will go up by 5,000. And it's double entry. Okay, double entry means if one transaction, if something happens to one account, there must also be another transaction, another account that, you know, will be affected as well. Okay, so we go back to the question. Cash sales of $5,000 for lessons. If the money in the bank account increases, okay, what else will also happen? Well, you can also refer back to the rule. Okay, we already know that something increases on the left side. There are only the first rules and the third rules that can be applied to this. So first one is something increases on the left side, something must also increase on the right side. And the third rule is if something increases on the left side, another thing on the same side must also go down. So let's look at the third rule. Is it possible or not? If bank increases, will the expenses go down? No, because it didn't say anything about being spent on any expenses. Will the drawings go down? No, because it didn't say anything about the owner drawing money out from the business bank account, right? So third rule is not correct, so it must be the first rule. If something increases on the debit side, something must increase on the credit side. If bank increases from cash sales, will the liabilities be increasing as well? No, nothing to do with loan or anything here, right? So liability is not. Capital, if cash at bank increases, will the capital increase as well? No. Transaction 1 didn't say anything about owner putting money in the business bank account. Third one, still in the first rule, if the bank increases, cash at bank increases, will revenue increase? Okay, well, yes, because when you read it, cash sales, you made a cash sales. Sales is another, I would say, word for revenue. Okay, so as soon as you see sales, the word sales, revenue will be affected. Okay, so sales is also arising from what the business does for their main activities. You know, what do they sell for a living? Okay, so sales can only be arise from when they sold their inventory for a living, right? So revenue will increase by 5,000. Okay, we're done with transaction 1. All right, transaction 2, purchase inventory for $2,000 on credit from Southern Hospitality. So transaction 2, purchase inventory for this amount on credit. Okay, when you bought a product on credit, okay, what are you creating? Same as how you walked into a store and you bought your computer on Afterpay. Okay, it means you're creating a loan. Okay, and a loan is like a liabilities, right? Here. And what do we name the account for a loan? Okay, so whatever, unsure, go back to this. Okay, accounts payable. Okay, because you have something to pay, you have something outstanding to pay, so you have an accounts payable to pay. So AgPay dash business name SH. Okay, how much do you have to pay? You have $2,000 to pay. And then what else will also happen? Okay, something increases on the right side. Go back to the rule, it's going to be the first one. Something must increase on the left side. Okay, what will increase on the left side? Will the expense increase? Well, we don't see any expenses in here. Will the drawings increase? Do we see any drawings in here? No. Will assets increase? Okay, why would asset increase? It's because you bought inventory on credit. Even though you created a loan, but do you get to take the inventory home to your business to sell? Yes. So that's why inventory will go up by $2,000. Okay. So again, to summarize, in transaction 2, you bought your inventory on credit, so you have an account payable to pay to Southern Hospitality, but you get to take an inventory worth $2,000 home to your business so you can sell it. Okay. Same with buying a computer on credit. You bought a computer on Afterpay. You have a loan, okay, that is worth the same as how much that computer is worth, right? If the computer is worth $2,000, you have an account payable of $2,000 if you happen to buy the computer on credit. But on the day that you bought it on Afterpay, you get to take a computer that is worth $2,000 home with you, you know, to play games or whatever. So it's the same idea here. Okay. Now, third transaction, credit sales of inventory to Otago Uni Staff Cooking Club for $2,600. The cost of the inventory was $950.30. Okay, again, there are two parts, two different numbers in a question, right? So let's look at the first part first. Credit sales of inventory to Otago Cooking Club for $2,600. What happens when your business sells your inventory on credit? Okay, so this is when, imagine you own a business and then you allow the customers to get the products first, or to stay at your hotel first, and then you allow them to pay you later. Same here. So Overcooked allowed Otago Uni Staff Cooking Club to, you know, buy some cooking equipment or some lessons on credit in a way that the uni can pay them later. Okay, so the uni already got the products, but they will pay Overcooked later. So what will happen here? It means our business, which is Overcooked, okay, now has account receivable, okay, accurate from Otago Uni, okay, OU. Why? It's because our business Overcooked sold the inventory on credit, so now we are expecting to receive money from Otago Uni. How much are we expecting? $2,600. Okay, what else will also happen? Go back to the rule. It can only be first or third rule. Will the expenses go down? No, nothing to do with expenses in the first part. Will the drawings go down? Nothing is about owner drawing the money out. So it must be the first row. So something must increase on the right side. Will the loan go up if they had an account receivable, like if they're expecting to receive money from Otago Uni? No. Will the capital go up? No. Nothing to do with the owner putting the money in here, right? This part. So revenue will then be affected. Okay, so revenue must also go up as well by 2,600. Okay, so an assumption that accountants have to make, and I already taught you this in the first test, is that accountants, we follow an assumption called accrual basis, where we are recording revenue coming in or recording any transactions as they happen, even though there's no actual cash being exchanged. Okay, so here in number 3, Otago Uni hasn't paid Overcooked, our business, anything yet, but we still record as revenue going up on the day that they bought our products on credit due to accrual basis. Okay, so recording transactions as they occurred, even though there's no tangible cash being exchanged. Okay. All right, so we're done with the first part of transaction 3. Second part of transaction 3, the cost of the inventory was $950.30. Okay, so if I told you this is how much you had to we had to pay in order to acquire our inventory, that means you also have to, you know, take COGS into account as well. All right, so my question is, if you sold your inventory on credit, do you still get to keep the inventory or the products that you initially have? No, okay, you can't. So if you sold your inventory, you will lose your inventory. So just underneath here, inventory is an asset. If you're not sure, yeah, inventory is an asset. You lose an inventory that is worth $950.30. And as I told you, there's always one expense or one cost that will arise every time you successfully sold your goods or your inventory, and that is called COGS, cost of goods sold. Okay, it will arise, and they're both on the same side. If inventory goes down, COGS goes up. So this is the same idea as when you successfully sold your inventory, you have some other costs to pay, like shipping fees or like shipping insurance, shipping tracking. Okay, so it's the same idea here. All right, transaction 3 done. Let's do transaction 4. Paid $250 for marketing. Paid, already paid. Okay, if it's already paid, and if it doesn't say paid on credit, okay, you can assume that it's cash. Paid means money already moved out from the business bank account. So transaction 4, the money in the business bank account goes down by $250, and then paid that amount for marketing. Marketing, what is the accounting element of marketing? Check. Marketing is the same as advertising. It's an expense. Okay, so this is the account name for an expense, and you call it marketing, and they both on the same side. If bank goes down, marketing goes up. Okay, next transaction, transaction 5, paid $1,000 to Southern Hospitality as part payment owing. Okay, so if it's a part payment owing, it means you've already encountered Southern Hospitality before. So then you look back, which transaction did you encounter with Southern Hospitality? Transaction 2, right? So transaction 2 is linked with transaction 5. Okay, so we look back at what happened in transaction 2. Transaction 2, we bought inventory on credit from Southern Hospitality, but transaction 5, we paid $1,000 of the loan, okay, that we initially created with Southern Hospitality. So initially we had a loan of $2,000. Now in transaction 5, we want to pay $1,000 of that $2,000 to Southern Hospitality. Okay, so what will happen to the business bank account when our business paid the loan to another business? So cash in the bank account will go down, okay, by $1,000. And then in transaction 2, we recorded that we had an account payable worth $2,000 to pay, but now in transaction 5, we paid $1,000 of that. So we also have to reduce the account payable down by the same amount that we paid them. And this rule, if something decreases on the left side, something should also decrease on the right side as well. Okay, transaction 5 done. Now transaction 6. Okay, Otago Uni Staff Cooking Club paid $1,800.50 for part payment of their account. Okay, so again, part payment, it means you've already encountered Otago Uni transaction before, and as you can see when we go up here, transaction 3 we already encountered with Otago Uni Cooking Club before. So transaction 3 is linked with transaction 6. Okay. Transaction 3 is linked with transaction 6. Okay, so we look back at what happened in transaction 3. There are two parts to the transaction, right? So transaction 3, Otago Uni bought our stuff on credit. It means we sold our inventory to Otago Uni on credit. So Otago Uni was able to have our inventory at that time, and they could pay us later, right? And now in transaction 6, Otago Uni came back to us and said, hey, we know that we had a loan of $2,600 with you, Overcooked, but now we want to pay some of it off now, okay, with cash. So what do we have to do? Okay, so if Otago Uni paid us, Overcooked, in cash, what will happen to the cash in our business bank account? It will go up by 1,850. And in transaction 3, we also had an account receivable from Otago Uni of $2,600. Okay, but in transaction 6, they paid $1,850. Okay, of that $2,600. So that means, okay, if the question is, can we still expect to receive? Can we still have an account receivable that is worth $2,600 from Otago Uni still, even though they already paid us with $1,850? The answer is no, because Otago Uni already paid $1,850. We can't expect to receive $2,600 anymore. We have to decrease the amount that we expect to receive from Otago Uni down. We have to decrease the account receivable that we expect to receive from Otago Uni down. So ACREC OU will go down by the same amount that they paid us in cash. Okay, that's 6 done. Now, transaction 7. BAM took out $1,000 cash drawings. Okay, so what happens when the owner, BAM, see, the owner is BAM. What happens when the owner took out $1,000 from the business bank account in cash? So the cash in the business bank account will go down by $1,000. And what else will also happen? It's already in the transaction drawings, okay? Will also be affected. And they both on the same side, they're both on the debit side. If the bank goes down, drawings will go up. See, they will. 7's done. Transaction 8, purchased a new computer for $2,000. So what happens here if the business bought a computer? Okay, what happens to the business bank account? Money in the business bank account will go down. And what else will happen? Okay, same idea. If you bought a computer with your card, not credit card, your debit card, the cash in the card will go down. The cash in your business bank account will go down, but you get to take a computer that is worth $2,000 home. Okay, computer will go up. See, they're both on the same side. If bank goes up or bank goes down, computer will go up. Because computer is an asset as well. Computer is the same as equipment. It's same. Okay, so if you label it as equipment, I will also accept it. Okay. Again, if equipment is there, okay, it's okay. It is an asset, as you can see. See, equipment is an asset. If bank goes down, equipment or computer that is on the same side, which is also an asset, it will go up. So 8 is done. Transaction 9. Received an invoice for internet costs from 2 Degrees due to be paid next month of $135.80. Okay, so what will happen here? Okay, you read first. Is it a cash or credit transaction? Has the money moved yet? Has the money in the business bank account moved yet? So it says due to be paid next month. So our business, Overcook, hasn't paid it yet. That means we have something to pay. That means we have a loan to pay. Okay, so we have a liability to pay. What would you name that liability? Act pay, account payable dash the business name, 2 Degrees, 2D. Okay, how much do we have to pay? 135.80. Okay, and something will also happen. If something increases on the right side, we look at the row, something must increase on the left side. So will the asset increase? No, because nothing to do with cash, nothing to do with account receivable, nothing to do with equipment. You have to look back. What is the accounting element of internet or Wi-Fi? Okay, will the drawings be affected? No, nothing to do with owner drawing the money out, right? So it's not correct. Okay, so what can it be? Internet. Look back here. Phone and internet is an expense. Okay, so for account name for the expense, we will name it internet. You can also call it Wi-Fi. I will accept both. Okay. Again, something increases on credit side, this thing must also go up as well. 135.80. Alright, transaction 9 is done. Now we left with transaction 10. Okay, Otago Uni Staff Cooking Club paid their account in full. Okay, if you don't get given any number, it means you have already encountered Otago Uni Staff Cooking Club. Okay, then you look back, which transaction did you encounter with them? You can also look here, whatever you labeled as OU, that's Otago Uni. Okay, so transaction 10 is linked with transaction 6, is linked with transaction 3 as well. Okay, transaction 10 is linked with transaction 6 and it's also linked with transaction 3. Okay, then you look back at what happened in transaction 3 and transaction 6. Transaction 3, we made a credit sales to Otago Uni, so they were able to pay us later. In transaction 6, they paid some of it off, because in transaction 3 we were expecting to receive $2,600 from them. In transaction 6 they paid $1,850 off. Okay, so they still have some left, so they haven't paid us anything. So they haven't paid us every single thing that we were after. So basically in transaction 10 they said, hey, Otago Uni now wants to pay off everything, so we don't want to owe you anything anymore. Okay, so what will happen here? Okay, have a think. They were supposed to pay us this much. In transaction 6 they paid us $1,850. So whatever the leftover is, okay, they are paying it off in transaction 10. So what is the difference between 2,600 and 1,850? 750. Okay, so they have an outstanding amount of $750 to pay, and in transaction 10 they want to pay it off. Okay, transaction 10, bank, the money will come in $750. And what else will also happen? Okay, if they paid us $750, okay, after transaction 6 we were expecting to receive the rest of the payment because they haven't paid all of their $2,600 off, but in transaction 10 they paid everything off. Okay, they paid the $750 that we were waiting for off. So can we still expect to receive $750 from them anymore? No. So we also have to deduct the ag rate down by $750. Okay, and then done with transaction 10. Okay, and then now you have to find the totals of each column. Okay, so what do I do here? Okay, I will just here. Okay, from the start, 5,000 plus 2,000 plus 2,600 minus 950 and 30 minus 250 minus 1,000 plus 1,850 minus 1,850 minus 1,000 minus 2,000 plus 2,000 plus 750 minus 750. Okay, so that's the total. 6399.70. That's the total for the asset. Move this up a bit so you guys can see. Okay, that's the totals, and then work out the rest. Okay, for the expenses, what do you do? Same method. 950.30 plus 250 plus 135.80. That gives you 1336.10. Drawing's not doing with anything, right? So just write the same number. And then now at pay. Okay, we have 2,000 minus 1,000 and then 135.80. So chuck that in your calculator. 1,000 minus 1,000 plus 135.80 gives you 1135.80. Capital, nothing, so 0. Revenue, so just add those number up, 7,600. How do you check that everything is correct? The debit side must be the same as the total on the credit side. Okay, so add these up, see if they are equal or not. So 6399.70 plus 1336.10 and then plus 1,000. You will then get 8735.80 on the left side, and try the right side. 1135.80 plus 1,600. You will then get 8,735.80 cents. Okay, so that's how you check that you've got everything correct.